This is how I bought a cash flowing triplex with none of my own money. I think a lot of people like to use this term as kind of a buzzword to get people involved in real estate because, yeah, I can buy real estate with none of my own money. Perfect. It is possible, but it's maybe not exactly what you think. So I want to help explain a little bit how this works and what people mean when they say they're buying real estate with none of their own money. And before I start, if you can drop a like or a comment on either the Instagram video or the YouTube video, it's super helpful for me to gather feedback and also to spread these videos to a wider audience so I can help reach more people and share more information. All right, let's jump in. So I'm going to cover 3 topics, which is how I bought this triplex in Denver, Colorado, how we rehabbed the triplex and what that project looked like, and then finally refinancing the triplex. And there I'll do a final project breakdown and share some of the numbers and how all that worked. So first off, I bought this triplex in relatively good shape, I would say. The purchase price was $750,500. It's 3 townhouse style units that are connected. So each one is a 4-bedroom, 2.5 bath, right around 1,600 square feet each. And townhouses are one of my favorite plays right now because they're in super high demand. As housing prices have gone way up, townhouses tend to be a lot more affordable than a whole single family home, but they're still big, right? 1,600 square feet can fit a whole family in 4 bedrooms. There's a wide audience for this type of property. And typically for the same money, you can get a much nicer townhouse than you can get actual freestanding single family home. So I think that these are going to be super popular going forward, especially while rates and house prices are fairly high. And when I bought the property, I absorbed 3 tenants. Each one had a year-long lease that were in various stages of their lease. And each tenant was paying somewhere between $1,800 to $2,000 a month. One of the units was recently updated, and 2 of the others basically needed complete updates. And they actually had what I would call hoarder tenants. They had tenants that had just tons and tons of stuff, and they had animals. They had like ferrets and cats, and you can imagine how it smelled in there. And it also needed a new roof. I love properties with hoarder tenants. And the reason is that it represents a lot of motivation for the person to sell, because these tenants are sometimes difficult to deal with and the property looks a lot worse than it actually is. So I'll show you some photos in a minute. People tend to think that the property is much more beat up than it actually is in reality. And the truth is, for $500 and a couple hours work, you can pay a few guys to clear the whole place out. And already the property is going to look a lot better than it did with all this stuff in it. And I actually bought this property from another wholesaler. So it's a large wholesaler in Colorado, and they have everybody who's interested walk through the property at once and then basically submit bids over the next hour. And I was the winning bidder. I beat out 2 other people that made offers, and I have a little bit of a secret to win these auctions. I don't want to just spread it all over the place and let everyone know, but if you're curious, DM me or leave a comment and I'm happy to fill you in on how I try to win every single real estate auction that I'm a part of. And here was the plan. So I penciled this out at a $1.05 million after repair value. This was based on comps in the neighborhood and actually an identical building that was under contract at $1.05 million at the time that I bought this. An $80,000 rehab budget based on renovating the 2 units and replacing the roof. And I saw, based on rental comps, that each unit could do about $2,500 a month. And I anticipate about 9 months to complete. And that's because one of the leases had just been signed somewhat recently. So I needed this tenant to vacate, and then I needed probably another month to do the work. So for that reason, it was going to be a little bit of a long project. This is what the property looked like when we got into it. You can see kitchen is dated. It's not in horrible shape. I think they had put in new LVP at one point, but certainly these cabinets and countertops can be replaced. But you can see what I was saying about the hoarder tenants. Each of these rooms looks really, really bad. It's because of this old shag carpet and piles of boxes and trash. It looks rough, right? And the owner doesn't want to deal with this type of thing. But I know it takes us maybe a day to clear this whole place out, and it already starts to look much, much better after we do that. So how did we do this? Like, where did all of the money come from to purchase this property, to renovate this property? And how did I do this with $0 out of my own pocket? So this is what people mean when they say they're buying properties with none of their own money. So first of all, I used a hard money lender, which is somebody who offers higher leverage for a higher interest rate typically. So they funded 85% of the purchase price, and they'll actually fund 100% of the rehab also. So I used Conventus for this loan. I've shopped out a lot of different hard money lenders, and I've found Conventus to be the most competitive, at least right now. We're here in October of 2023. So what they were offering is 0.5 point of origination fees, which means 0.5% of the overall loan up front as a fee, which is pretty good. A lot of other companies are asking for 1.5 or 2 points. And then they offer 10% interest each month. And then the rest of the money actually came from a private lender of mine, and they were willing to lend 15% of the purchase price at 6.25% interest. And private money lenders can come from anywhere. In some cases, it's a family member. In some cases, it's a friend. It can be somebody that you met at the golf course. Just anybody who's willing to lend you money. And the truth is, 6.25% is probably better than what they're able to get passively. So a lot of people are willing to do that as long as you have some experience and you can show that you know what you're doing with their money and will be able to pay it back. All right, so let's jump into rehabbing the triplex. So at this point, I had bought the property and we're getting into the work, and we actually had some good news. We got the first tenant out in about 2 weeks, and that's because their lease had just ended and they were willing to find another property. So we worked with them, and I gave them a little bit of extra time to find their new location because I really like working with tenants and they were really cooperative. So we were able to get in and start that unit about 2 weeks in. The second tenant that had the longer lease had actually been behind on their rent to the previous owner. So they were behind about $3,000. And I explained that I was willing to give them a forgiveness in their rent in exchange for finding a new place to move to sooner. So I basically released them from their lease in exchange for forgiving the debt. But let's remember, the debt wasn't actually even owed to me. It was actually owed to the previous owner. So that was sort of icing on the cake. I was able to leverage, the money that they owed to the previous owner. In some cases, people will do what's called cash for keys. They might offer $500 or $1,000 and say, hey, we have a plan for this property. If you're willing to take off within the next month, we'll give you $1,000 when you turn in your keys. So this is a similar form of that, but it was money that they actually already owed to the previous owner. So this is the project, and each unit took us about $23,000 to renovate. You can see this is just a screenshot from my actual budgeting spreadsheet, and we projected $25,000 for each unit. This was the total labor cost. We paid about $11,500. In materials, we paid, again, about $11,500. That's what I've found, is that typically labor and materials are something like a 50-50 split if you have a reasonable contractor. And these are all of the materials that were paid directly by my contractor. These are the materials that I paid for myself, items from Home Depot, and items from a flooring supplier that I use. So overall, each unit took $23,000. We also replaced the roof. We got a really competitive bid for this. $10,000 for a roof on a triplex is pretty darn good price. And the entire project took $56,000 for us to completely renovate the entire triplex. So a couple of small notes here I want to add to this. Set really clear expectations with your contractor. And if you're curious what that means, I could probably make a whole additional video about all the things that you should arrange with your contractor. Let me know in the comments if that is interesting for you, and I'm willing to make that video to help explain. But in this case, I put down 35%. Never, ever, ever put down more than 50% for your contractor, okay? Because the second everything's paid off, the work stops. So you need to set clear expectations about how much is paid up front, how much is paid during the project, and what needs to be done for your contractor to be completely paid out, okay? A second note is I cover the majority of the materials myself. So there's 3 reasons why I do that. One is for quality control. I get to pick the materials that are going into the townhome. I want to make sure it's not too expensive, but also not too cheap. So I get to basically sign off on each thing that's ordered for the project. The second one is credit card points. This is huge, right? If you're spending consistently $10,000, $11,000 per project, and that's all going onto your credit card, you're earning a ton of credit card points, and we're using these points to go on vacation. Right, we're going to Thailand and Vietnam in just a few months, and credit card points paid for all of the flights for me and my fiance. And finally, Home Depot also has a pretty good reward program. So they'll give you money back, they'll give you discounts if you're buying enough product from them. So for that reason, I like for everything to go through my own Home Depot account. And then finally, I have an awesome flooring vendor who I found just in the past couple of months. Really high quality luxury vinyl plank, and it's delivered anywhere you are in the US for about $1.50 a square foot. If you're in Texas, you can actually get it for cheaper because they're based in Texas. And if you reach out to me, I'm happy to share the contact information and connect you with them if you're looking for really high quality and inexpensive flooring. Okay, so back to the project. Let's remember what the townhouse looked like before when we bought it, we got into it, and this is how it looked after. So nothing super fancy, just remembering that this is going to be a rental property, right? So we're not doing a super high-end fix and flip. We cleaned up the kitchen, we got new cabinets and countertops in here, new LVP, just made everything really nice and clean and durable. For $23,000, we have 2 units that almost look brand new, and we have really happy tenants in here now. Okay, so quick recap so far. So the money that we had on the property was 85% of the purchase price and 100% of the rehab from a hard money lender. So right off the bat, I borrowed $637,500 for the purchase, and they offer the rehab money as a draw, which means as you complete the work, you can send confirmation to them, usually just photos that you've done it, and they will release some of the money to you. On the private money side, we had a 15% purchase price from a private money lender, and that's $113,500. So these two make up the complete purchase price. So now that we had completed the project, it really only took 2 months to complete versus the 9 months that we had planned, which is really nice. So we planned for the worst case scenario, but we were able to work with the tenants and find something that worked for them and worked for us. Rehab also came in below budget, so $56,000 versus the $80,000 plan. We were able to re-rent the 2 units for $2,500 a month plus utilities, which is great. I wasn't 100% sure if we were going to be able to add utilities on top of that, but we had lots and lots of interested parties. And we got a $1.03 million appraisal, which is the after repair value. And that's just a little bit lower than we had expected, but it gets everything done just the same way. One quick note I want to add here, I think someone will bring this up if I don't mention it, but I'm leaving out some of the smaller fees and carrying costs for these calculations just because it simplifies things a little bit. You can get really detailed with the math, but the truth is So it's about $8,000. Plan to spend a little bit of extra money than you calculate initially. Okay, so this is what the refinance looks like. And like I mentioned earlier, I think Conventus is one of the best lenders in the market right now. There's another reason. When I did the refinance, they actually offered a $0 origination switch over to a DSCR, which is debt service coverage ratio product. And that's really nice because typically when you move from short-term money to long-term money, you're going to pay another origination fee, which could amount to tens of thousands of dollars up front. But because I did the initial short-term loan with Conventus, they have a program of switching your short-term money to long-term money within the same company with a 0-point origination fee, which is awesome. What does DSCR mean? DSCR, debt service coverage ratio, means that the lender is only looking at this property for you to qualify for the loan. So typically, if you go and buy a primary home, they're going to look at how much money you make each month. They're going to look at how many assets you have. They're going to look at your credit score. They're going to look at lots of things to make sure that you qualify for the amount of money that you're borrowing. Where with a DSCR loan, all they're looking at is how much income does this property generate, and is that enough to cover all of the expenses, to cover the entire loan, basically, and still have some buffer left over. So DSCR can be super powerful if you've borrowed a lot of money already, or if, like me, you don't work a traditional job. They're not looking to see my monthly income. They're just looking at this property to make sure that the income coming in will cover all of the mortgage and expenses going out. A lot of people have heard BRRRR. It's buy, rehab, rent, refinance, repeat, right? And it's a strategy that a lot of people in bigger pockets have cultivated to buy more and more properties without using a lot of their own money. And how does that work? It works on a term called forced appreciation. And that's when you put in a certain amount of money, hopefully a small amount of money, to create a large amount of value or equity in the property, and then refinancing based on the value that you've created, right? So we went from a $750 purchase price and $56,000 in to create a value of $1.03 million. And then you're able to refi at 70% of loan to value. So whatever the end value is, 1.03 million, you can pull out 70% of that. So I was able to pull out 98,000 at closing. I'll show you in a minute. It doesn't quite cover all of my expenses, but it does cover a large portion of it. So if you're following along, we've got a 1.03 million after repair value, minus the purchase price, $750, minus $52,000 in rehab, which means that we created, sorry, I realized I just messed up this number here. It's not 52,000, it's 56,000. I think I got it right. Yeah, in the spreadsheet here. So at the end of the day, we created $224,000 in value. Some people call it equity. I'm not going to call it equity here because I actually pulled some of the money out of the property, and I'll explain that right here. So this is my super simple deal calculator, and I'm happy to share how I came up with this. If you have more questions, you can reach out and I'll fill you in. But these are the loan terms. I'm refinancing the initial loan at 8.25% interest only. So interest only is nice because you have a little bit higher cash flow at the end of the day. $735,000 is 70% of 1.03 million. So that's the 70% LTV I was talking about. And these are all the numbers. So we're renting the entire property at $7,500, which is $2,500 a unit. The primary loan will cost us $5,053. The secondary loan that I have costs $591 each month, and taxes are about $400 a year. Insurance is about $400 a year. I'm personally managing the property myself with the help of some suppliers. I'm not going to take into account miscellaneous things here because we just did a rehab, so I don't expect we'll have too many repairs in the near future. And then for HOA, there is none. For utilities, I'm going to offset that because the tenants actually pay for the utilities themselves in this case. So you can see total coming in each month, $7,500. Total going out, $6,444.27, which means cash flow each month is $1,000, 55.74 cents for just under $13,000 a year. How do people measure how good a deal is, right? How do you know what property you should buy and what property you shouldn't buy? Two really good indicators for this are cap rate and cash on cash return, which is abbreviated COCR. So what cap rate is how much gross income are you making divided by the purchase price of the property, and really everything that you have in the property. So it's the purchase price plus the rehab that you did. So the cap rate here is basically all the money that we earn after expenses, right? So you take $7,500 and subtract off your taxes and insurance, make that an annual figure, and then divide by the total price that you have into the property. And that's how you get a cap rate, 9.98, which is pretty darn good in Denver. A lot of people would be happy with 6.5% or maybe 7%. But this is a good way for you to compare how much money is a particular property generating versus other properties in that area. And it's a good measure to compare within the same neighborhood or within the same city, because typically investors have an idea what a good deal is versus a not so good deal. You can use that to compare. The other measure that I use is called cash on cash return. And this is basically how much money are you putting back in your pocket each year versus how much money did you come out of pocket for the investment. So at the end of the day, after I take this $98,000 back when I refinance, I'm gonna basically have $15,500 that I'm putting down. And what that means is I have a secondary loan, right? I have to pay off this private money lender eventually. So the $98,000 will cover most of this, but if I was to pay it off today, I would still be $15,500 out of pocket, plus all the rehab money, which was $56,000 that we said earlier. So the total that I would be in if I was to pay off the second second mortgage, would be $71,500. So what does that mean? If I was to pay this off today, take $71,500 out of my own pocket, I'd be getting back 17.7% of my money each year. So if you're calculating that out, it would take you about 6 years to recoup your investment. And at that point, you've taken all the money that you took out of your pocket for this property and you've made it all back, which means that you've recouped your original investment and now you own this triplex, and all you've really put into it is your hard work, your sweat equity. You don't actually have any of your own personal money in the property anymore. So this is my simple real estate deal calculator. And I do go into more detail sometimes, but this gives you a really nice, quick, rough look at the important numbers and KPIs for a rental property that you're buying. You want to look at the rent, you want to look at the primary loan and how much you're spending, and the secondary loan if you have one, as well as the taxes, insurance, management costs, miscellaneous, which is just any repairs that you're anticipating each year, and the HOA versus utilities. And then I have some nice calculators down here for comparing properties against each other. And that's basically it. So now this property is more or less on autopilot, and the only thing I really have to deal with are some small repairs here and there, releasing it if a tenant decides to leave. I plan to hold this property for a long time, and the icing on the cake is if rates come down, which hopefully they do in the next 2 to 3 years, I can refinance and the numbers will just get even better. So in conclusion, You can absolutely buy cash flowing rental properties at high interest rates like we have today. The key is finding distressed properties, underwriting the deal correctly, and doing the work efficiently. Minimize your risk by overestimating the time and money involved in your project. Overestimate the possible interest rates when you refinance, and underestimate the ARV that your property will appraise at. This will make you happy when you beat your own plan. Thank you so much for watching. I really appreciate your time. Drop a like, drop your comments on YouTube and Instagram. I'm super curious to hear what you have to say. But also, if you see holes in my plan or places that I could have improved, I would really like to learn about that too. So drop your likes, comments, and subscribe for more videos. I'll try to put something new out every single week. And until then, see you next time.